Good afternoon, everyone. Hope everyone's doing well. I think my headphones didn't connect, so give me 30 seconds and I'm going to get that going. Those that joined in live on the podcast, it's where I'm in a very festive holiday sweater right now, as you can see. It's for the holiday this afternoon here at Hedgeye. We got a bunch of folks that have come in from really all over the country in terms of like where they normally live. And we had a great company meeting yesterday afternoon. We took, playing a little hurt this morning, or this afternoon, but hey, the life goes on and everything's good to go. Markets doing some fun things out there, and ECB put out, followed up with the Fed announcement yesterday, and just putting the pedal to the metal, higher for longer. That's really my big theme today. Higher for longer. We're going to talk gold. We're going to talk volatility. We're going to talk dollar. So we'll get right into it. Trend. Thanks for being able to make it this afternoon. Always a pleasure to have you on, buddy. Let's see, Jimmy, a lot of friendly faces out there. So again, if kind of this is now kind of happening on two places, so you can listen live and participate here on Twitter Spaces. And then we're also kind of doing a broadcast via YouTube on the Hedgeye TV YouTube channel, as well as on the website. So you can kind of visit three different places. But that's probably enough. It's not really rambling, but kind of backstory here, and we'll just dive right into the numbers and the signal. I think today is a day for action. Trend. What's going on with you? And I know from our DMs, you definitely came into the day. Maybe not quite as net short as Mike T, but certainly approaching there. That's for darn sure. So
Yeah. Am I clear? I'm on the
you are.
headphone. Just want to make sure I'm clear.
You're very clear. Very clear. Welcome, Papa
Excellent.
Bear.
Excellent. Okay,
Absolutely.
great. So yes, in the last 2 days, 3 days, I've been accumulating the short positions. I did miss out on picking up some longs that I should have, and it was just really chaotic last 2 3 days, both on personal front, work front, and then of course investment front. But it provided so many opportunities. I had put in some limit orders to tag some of these uh, certain specific stocks which were on my fundamental and techno short radar. So some of them include software names such as CoStar Group and a few of them that I tweeted out. I will put it in the tweetness above. But also on the rates front, we have had an interesting move. I've been carrying my TLT position from about 102 when I got a signal to turn around. I picked up certain long positions. I booked them yesterday when the just before the FOMC announcement came out. I didn't want to go in with that into the FOMC announcement because that was a decent $6 move on TLT. I don't carry it at the moment. I don't have a opinion on it at the moment. Um, from a standpoint of the S&P 500 sectors, we are seeing strong momentum, broadly speaking, in energy, industrials, a little bit of staples. Surprisingly enough, a bit in materials on a slightly longer basis, but that's losing out. So healthcare and utilities have been two places. Now, folks have asked me that, hey, in healthcare, are there any specific names that you like? Um, I did like SGen when it was in the sub 120 level because it's going through that merger arb sort of situation where uh, there was a company that was Merck was going to buy them, but then they ended up buying IMGO. Now instead, SGen is left to the mercy of GlaxoSmithKline, which is interested in the specific nature of work that SGen does. But other than that, in XLV, J&J is doing really well. Merck is doing really well. And from my standpoint, I do need to accumulate those longs just to balance out my short book, just for the sake of everyone having same information. What Rob was referring to was coming in today, I was at about 63% net short, and that is to be blamed on me. I don't want to be so heavily net short in general. It was partially because I failed to add my longs. I've been keeping an eye out on the risk uh, as well as the real time alerts to see if there are certain longs that I could accumulate. From a rate standpoint and dollar standpoint, I don't have any position in currencies at the moment, especially after the dollar breaking, uh, uh, certain specific levels that I was looking for. And on rates front, it will be a wait and watch for me. But on equities, definitely a good day for some of the positions to be booking gains or trimming from say max short to mid or even in min in some cases. And I still end up holding about 45% cash. So that's from me for the moment. I'll chime in as suitable topics come in. Back to you, Rob.
Yeah, absolutely. Good, great summary, Trent. Always, the crew always appreciates kind of that rundown and that kind of thing. So thanks again for being open and transparent with your book. And yeah, I mean, so the dollar to me trend and this is obviously kind of we had the Fed meeting yesterday. It popped kind of out of the gate and then sort of then kind of closed a little bit weaker into the end of the day, but with the ECB and Bank of England coming out this morning. And I've shared a couple tweets that I had this morning. And again, I think it's really, really important to go through those. It's like 3 or 4. So go through those. They're in the tweet nest here. 210 spreads. Richie gave me that information this morning. We've got the Netherlands in particular was a huge call out in my humble opinion. Where it's at the largest yield curve inversion since 2007, right at I believe it was minus 0.06. And so these are big things that are happening, and ECB. I even shared a clip from their CNBC Europe today in terms of her speaking about basically reiterating exactly what Powell said yesterday. Right? There's no pivot. There's no pivot coming. If you guys follow me or look at my tweets, it's basically exactly what I was saying. We're trying to reiterate to everybody yesterday, right? Like nothing has changed. At least zero has changed. Kind of momentum, it's kind of picking up to the downside, and you've seen that transpire the last few days. You really seen that last probably week and a half, right? I think it's the S&P has been down, I believe, about 9 or 10 out of the last kind of like 12, 13 days. So that's it's really important to kind of keep track of where those are, and then obviously within the risk ranges, what's happening from an oversold or overbought situation, and where which is where we are, right? From a dollar standpoint, yesterday, it was if you weren't acting there, in my humble opinion, you just aren't paying attention and really aren't setting up your book longer term for what's on the horizon, right? And yeah, the chart's up on the screen here. You've got a 3 month window where it's gone from call it 114 to 103. That's a huge move, right? It's been a huge counter trend move. It did not break trend. Trend last I got it from Keith, which was on the 13th, is down just above 103. So again, it held trend. It was right at the low end of the risk range, and that risk range is basically hovering, kind of right around the trade line of kind of just under 108, right? So this is an important setup. You go across emerging markets, you go across even just U.S. equities, you go even rates, right? Like the kind of correlations there have been pretty intense, and it's kind of a lot of it's been sort of this based on quote unquote based on this counter trend move from the dollar. And you're seeing that U.S. dollar correlations on a 15-day basis have started to weaken. Right, the S&P is only at a negative 0.18, whereas on a 90-day it's negative 0.77, on a 30-day it's negative 0.81. The gold, conversely, has come down has also come down from minus 0.79 on a 15-day, and on 9-day it's negative 0.89. So again, if you go back sort of 2-3 weeks ago, or even just a couple of days ago, the gold had a minus 0.95 15-day correlation on the 13th. As I said, today is a minus 0.79. These are only one little data point, but in the S&P is negative 0.09 on a 15-day 2 days ago, and now so that has kind of increased, right? But these things are really important to kind of track on a regular basis. Looking at these signals You still got a lot of bullish trends in the U.S. equities, as Trend was kind of just alluding to, right? So look at that pin sheet, and the pin sheet is the risk range that we get out every day. That those are places where you can go hunting, right? We get those updated ETF Pro. You can kind of cross reference the trend signal there, or the trend ranges, and see where exactly we're fitting, not only on the immediate term kind of range setup, but then also on the longer term trend. So we got the chirper coming in. Welcome, Chirp. I think he's connecting. Anyway, I'll just keep rolling until he connects. I don't know what's going on. Hey, Chirp, welcome, buddy. Good to have you on. You're muted, so when let me kind of keep running through so the a couple things here, and then we'll come to whatever question you have, buddy. So the other call outs to me, obviously, as I said, kind of the gold correlation. I wanted to just point that out as well, right? So the gold correlation, where gold is in the risk range. Again, these are, this is, there are components out there where you can really get set up for this next phase. So the next phase kind of, leg lower. I think it's possible, or certainly it's appearing from a signal standpoint that it's shaping up to be a kind of a bit of a different setup in terms of what our books might be able to have within it, right? So kind of year to date, and there was certainly a big period of time there where we couldn't, or not that we couldn't, but having kind of equity exposure at all was really, I guess, useless, and because it just everything was, going lower. And now we might get back to that point in time, but currently, currently there are places to hunt, right? And so just follow those signals, follow the, follow the map, I guess, right? And go execute. So so I think that's probably all I have at the moment. So Chirp, welcome back. I think you had to drop off there. Did you have any commentary, questions, either for myself or Trend? Something's going on with your audio, Chirp. You might need to just drop a little and come back in. Palmer.
Hey, Rob. How you doing, bud?
Hey, buddy. I'm doing well, man.
Hey, just two things I wanted to see what your thoughts may have been, or anybody else's. Oil.
Yep.
I noticed OVX looked to me like it was really going to take off this morning, so I added. I long only and usually mess with the leverage stuff, so I increased my position size on SCO. I've got one more shot to take if I want it. And then the other thing,
Okay.
I can't make heads or tails out of China. I've flipped back and forth between yin and yang so many times this week. I've taken the go both ways to an extreme, and I can't quite figure out what it's doing. So love to hear your thoughts or anybody else's.
Yeah, volatility is a good call out, right? I mean, I think if you kind of look across the board, volatility in general, kind of it's been a similar thought process, or similar kind of the data is kind of similar reading, in my humble opinion, over the last we've had the price of vol, right? Now, so like for OVX, for instance, it's down 166 basis points on a month-to-month basis, and down 155 day over day. At least that was like coming into this morning. So that move is important, and where it is inside of the general range. We're kind of right down at the near the bottom of where it's traded, right, over the last 3 months. And this is, again, I mean, this is kind of, I think they're all sort of correlated, right, Palmer? In terms of oil to me, obviously not to me, excuse me, the signal just says it's bearish trend, and you've had a counter trend move here with this sort of like suppression of oil vol over the last sort of 10 to 15 days. So I think that's about it. To me, it's a relatively simple kind of like A plus B equals C. It's sort of a good spot here at the top of the range. Again, it could be, but it is a little bit tricky because there are other components like and this is a good segue into China, right? Like China, the quote unquote China reopening. I mean that could impact demand. If they can get their act together, and quad ones are kind of on the horizon there. But do you really want to act on that now and sort of try to predict that, or do you really just want to do what the market's doing? And to me, I lean the latter, and the market is just, in my humble opinion, just a counter trend bounce here.
Andrew, I'm kind of staying away from the whole oil thing.
Yeah, I would, and Keith had mentioned this, I believe, either today or no, it was yesterday on the macro show, in terms of, it could be time. It might have been this morning actually. Yeah, it was this morning. Sorry. In terms of shorts, like equity oil exposure shorts, and I think that's spot on. Like if I think this oil, like the actual commodity itself, could trade kind of sideways here, and it's really not going to change anything from a from like a signal standpoint. But the equities themselves really could have a lot, kind of have more downside risk, especially as they start to report kind of um, earnings with the most recent sort of oil pricing of kind of call it 85-ish dollars, right, over the course of the last quarter.
Also, I do want to add that just in general, from a mental bandwidth and risk management activity perspective, I think there were some easier plays, and they still exist as a setup. For example, if you look at Austria, right, EWO, uh, Austria from Europe is such a juicy short at the moment that it's a no-brainer. So that's why when it was in the 19 handle, I pounced on it. Same with EWG, EWI was another one, Italy, and France and Netherlands also
Oh
to a
yeah.
certain degree. But the easiest one was Austria from a standpoint of where it's at, where it can go, what low it can uh, knock off to get a new low, those sort of things. That's why I was kind of trying to steer clear of oil, which had a lot of headwinds and
Yeah.
tailwinds at play.
Yeah.
Yeah, back to Europe. Yeah.
Hey guys, how are you guys doing? I just wanted to ask Trent, in terms of your positioning sizes, like for shorts, how much are you short in terms of position size, like 7%, 20%?
So when I say I'm net 63% short, it means that I had almost 90% of my book, which was short. And then it was balanced by about 27% long, which was poor risk management on my side. That's why it's net short 63%. So I was short about 90% of my book. This includes everything. So equities, any put options, or any sort of written calls or written or bought put verticals, everything combined, that was at about 90% part of the book. But I did have 27% long. That's why I got to the 63% net short. As far as individual tickers or individual stocks are concerned,
Yeah, Trent, I
it
don't know if it's
depends
just me,
on.
but some of the audio's cutting out a little bit.
Okay, I'll come back in a minute.
Palmer, is it just me or
I was hearing him loud and clear. Didn't miss a beat.
oh, okay. It must be on my side then. All right.
No worries. Is this better?
Yes.
Okay, great. So for individual tickers and stocks, if it's equity, then I go to about 4 to 5%. So for example, on EWI, I have about 4% short position. For EWG, I chose the puts. In just levered puts, I usually tend to keep about 1% of the capital max exposed to a position. In very rare instances, I would lift it to about 2.5%, because puts are such a place where the stop losses tend to be much deeper at about 50% or even sometimes 60% drawdown. So I hope those three data points help you. One at the aggregate portfolio level, two at the individual security level, and three at derivative level.
Yeah, I mean, Trent, the European shorts, or on the European side, I mean, again, that's if you kind of pull up, it goes back to my commentary about the dollar, right? And obviously they've benefited hugely from dollar weakness, euro strength, and then obviously also the indices themselves have had counter trend move. But yeah, I mean, Italy has been absolutely a wicked short. We that went on the ETF Pro on April 4th, along with EPOL, and on a relative basis, those have been up, an incredible amount. I think absolutely. Anyway, I tweeted it out there, but on an absolute basis, we're those have been great, this year. And I think again, it's a similar trade, obviously, right? Trend in terms of like if you're going long the dollar or short the euro, shorting these is a similar trade, but it is a good way of kind of you can pick your spots in terms of obviously there's a lot more beta on the on the equity side, but you can pick your spots and diversify a little bit and kind of have to your point different varying exposures in terms of sizing and that kind of thing as well. And I think it's going to be a great place to have some short exposure. Norway has been one that Coach has mentioned on the macro show, and again, that's obviously with Norway is a play or sort of has that oil exposure as well. So I think that's the energy side of the house, and then materials and certainly industrials. I think those are really places that in this next phase down with demand slowing and global recession on the horizon, those could be really great places to kind of go hunt and on the short side.
Yeah, and I do want to add one more factor in there, right? The factor of dividends. So if companies are having really strong cash flows and they're able to pass on the inflation and they're still able to maintain their dividends, I try to not be super short on them. If I do have some short, it would be tactical. For example, I did some Microsoft play, but that's usually the mechanism that I would try to do in my overall screening part. And then on some of the screens that I run, right, there's an element of net debt to EBITDA, net debt to EBITDA minus capex, and how it's trending. Those sort of aspects, they give some interesting results. So there are companies which we may not be tracking, but are say in the 1 or 2 billion plus sort of market cap arena, which tend to set up really well. So we heard a lot about MPW and Steward, but amongst the healthcare facilities, there's a couple of other stocks too, which interest me from a similar standpoint. One of them is called Surgery Partners, and another one is called Select Medical Hospitals. Both of them are worth analyzing further if you want to form a view about fundamental shorts on them. Definitely have a look. So, uh, this is a good time to get into the arena where you would try to understand uh, that one, the headwind in the financing is going to affect some of these companies with their debt maturities coming up in 2023. And on the other hand, the revenues are also getting hindered. That essentially means that equity is going to take haircut after haircut after haircut. And then equity markets would try to sniff it a bit ahead of time, and then it would take a beating in terms of the evaluations overall. Now, on the other side
Yeah,
of
I'd say Trent,
this,
just before we move, like I think that's a great segue into HYG and junk, right? I know you. I think
yep, yep.
yeah, and just again the counter trend moves there that have occurred over the last call it 3 months, 3 months or so, or certainly 6-ish weeks. Yeah, just talk about like a great setup there in the last few head to both the CPI print and FOMC.
Yes, definitely. So JNK, HYG tend to form really attractive pools for long-term holders or even holders who need income. Because if you look at JNK and HYG, they tend to give monthly dividends. At least JNK does. I don't know about HYG as much. But the other part is that when some of these companies would come up for their refinancing of debt, now given that uh, Powell has been really clear that we're not backing down. There's no rate cut in 2023. It is very clear that some of these companies are going to face significant issues. Not all of them, but definitely quite a few of them, and or their earnings are going to turn. So what do I mean by that? For example, if Netflix was getting their junk bonds at 4.5% without much covenants, either they start giving covenants and be in a non-junk category, which they wouldn't, but if they do, uh, it will take a beating on their equity. And i- if they decide to refinance in junk itself, the cost of refinancing now is double. So now that doesn't bode well for their labor costs, meaning either they'll have to do some layoffs further, or they'll have to try to push the price increases to the customers, which can affect their volumes. So in general, some of these companies become interesting plays. For example, Netflix, because of the easing financing conditions, the stock had hit almost $320. And whenever I talk about Netflix and junk bonds, people are looking at me always like, "What are you talking about? Reed Hastings cannot have junk bonds." Go and look it up, right? And JNK ETF, Netflix has at least five securities amongst their 1,200 plus securities that are being held in JNK. So this again brings up a good setup, as Rob was saying, for both HYG and JNK. HYG tends to be slightly smoother as compared to JNK. JNK tends to give you much more volatility, because keep in mind, these are risky assets, right? Even a 2% default or 3% default can cause chaos for folks who are holding these assets. For almost the longest amount of time, JNK kept trading at a 108, 105, 108, 105, 108 levels. In times of distress, when March 2020 happened, it did come down to 80s. We are back to about 92. I'm not necessarily saying we're going to have a March 2020 like distress. We could actually have even worse, because in March 2020, it was just buyers picking off bids, meaning it was bidless selling that was happening. But at the same time, Fed stepped in on March 23, 2020, saying, hey, we're going to support the junk market. And that led to significant turnaround and astute buyers jumping in to buy junk rated securities at 50, 60 cents on the dollars or even lesser. This time
Yeah,
around,
Trent.
that
Yeah,
doesn't
Trent. I mean,
exist.
no, exactly right, buddy. And I think the other thing there too is this higher for longer theme, right? Which I think is glaringly obvious out of both the Fed and ECB, is that this is not it's a new environment for to price out cost of capital, right? And that hasn't even been it's only in its very infancy in terms of impacting one, decisions that are being made, and two, the junk bond market itself. And that's something that I think you really, that's why I keep harping on this higher for longer, because this is the new normal and people aren't ready for it. Yeah. So the other call out, or the other thing that I really want to these and the commodities, particular Joe. So Joe, the coffee at a -6% eyeball discount this morning, and that was a negative 3 times on the Z trailing 12-month Z score. So it's definitely something that I see with a notebook. Highlighted it on macro show yesterday, along with a couple other model Fs. Definitely. Figure it out. It's my phone, I think, is
You're
glitching
cutting
up
in and
because
out.
I just sounds like
Yeah,
General just told me that I am
yeah,
cutting in and out, so I'm not really sure what's happening. So we're just gonna power through it here.
yeah, you were.
Yeah. So thanks.
Yeah,
Can you hear me okay now?
yes.
Yes.
All right, cool. All right. Well, I'm not gonna repeat myself. Awesome, Arthur. Welcome, Asim. Always a pleasure to have you both on. How you guys doing? Arthur, I'll go
Good,
to you
good.
first. Yeah.
Oh, thanks a lot. I appreciate it. The
Absolutely.
reason I jumped up is I wanted to kind of get a flavor from Trend or whomever. This junk bond high yield market, I've been playing that quite a while, but what's the catalyst in here? I understand the setup, higher for longer, looks like an earnings recession. All that's very correlated to this credit market. But do you see a catalyst? I mean, do these companies have to? Is there a point in time when they have to mark these things, and there's some catalyst in the near future, or does it just happen? As each company comes and tries to, recapitalize their debt if they have to.
So let
What's
me
the
give you a couple of catalysts, right? So take a look at this company called Avaya Holdings. It's in IT space, and a lot of Fortune 500 companies used to have Avaya telecom equipment as their standard. Now, given
What's
that
what's the ticker trend?
Alpha Victor Yellow Alpha. So they used
Thank
to
you.
trade at about 20-30 bucks. They were kind of a go-to equipment maker. And look at their debt. Look at their debt and look at their earnings ability to service that debt. Now that stock has become a $50 million stock. It used to be a $2, $3, $4 billion stock, primarily because their debt has just crushed them completely. Now think about this in context with several other similar companies in which, one, the revenues are going to start facing a pod 2 pod 3 sort of situation, as Hedgeye likes to explain about the pods, and then also carrying this kind of dead weight debt on them. The combination of those two, whichever companies get affected, right? So in print publishing, there's another company called Gannett, GCI. It's a $320 million stock. So these are just stories in the rear view mirror for you, just to get a sense of how that playbook occurred for these stocks, and which will be the next set of stocks which will give you that sort of an impact, or that sort of a setup. So I mentioned a couple of healthcare facility stocks earlier, SGRY and SEM. Similarly, there are several others. If you dig into them, for example, in the ESG space, you'll find some of them. Um, you'll find that their earnings story is going to uh, not play out the way that the management is explaining, while their debt is going to start crushing them, especially when they start going out to financing. They'll have to start issuing more equity, which means further dilution, which means further equity going down. So it becomes either an ARB play for somebody who wants to play on the bond equity ARB side, or you can just be directly short on the equity side. So that's typically the catalyst for these things. Now, I'm not expecting the junk defaults to exceed 10%, but between now and 10%, that's a lot of equity getting wiped off. Meaning, if you look at the overall bond market, right, like from a sense of what's trading right now in equity markets, it's about close to $5 trillion. It's much higher than what we had, let's say, back in March 2020, or even, let's say, back in 2008. A 10% default in that is a big number. And that tends to hammer away equity almost 5 to 10 times more when that default happens. So just look out for the debt defaults that would happen, and that would not only result in actual equity wipeouts, but also for uh, confidence to go away for investors, resulting in even normal, stocks to start getting hammered in terms of the valuations. Now, I'm not saying that this would happen for the good stocks. The good stocks, meaning the stocks where earnings are going to be sustained, or they can pass on the pricing without volume impact to their customers. It won't happen for companies which have a decent amount of balance in terms of their debt. So, for example, if you are thinking that Apple and Microsoft would get affected in debt financing, no, that's not the story that we're talking about. We're talking about literally, down the credit rating pole.
yeah,
Uh,
yeah,
yeah.
yeah,
Yeah,
yeah. Thank you,
and
Trent.
just
I
and
appreciate that.
Arthur, I think again, it's just early innings, right? It's early innings of. I
Well,
mean, we haven't
that's
even.
exactly hit my point, Rob.
Yeah,
That's where I'm trying to get to. I'm playing it at the ETF level,
yeah,
and they're at or close to the top end of their range. In fact, I think Keith
I would.
said again today on the macro show. I think he said probably the last 3 or 4 macro shows in a row, how that incrementally whatever your min max is, you should be, hitting on those.
Yep.
And so I have been, and I'm sitting here, and it's, it's starting to work a little bit. It looks like it's getting a little teetery in here, but I'm still anxious as to, and maybe there's a correlation when some of these things start to happen that Trent just alluded to. And I appreciate that input, Trent, that somehow there's some contagion. And certainly, obviously in Apple or these, I'm not talking those kinds of companies. I'm talking about stuff that's junk, and
Yeah.
there are,
No,
and so,
exactly. And that's where, and Arthur, I mean, that's where, the GDP that we're about to see print, right? That's
yeah,
coming on the horizon,
yeah,
that we're in the nowcast. That's
yeah,
basically, call it sub 1%, sub 1%. And really, on a quarter over quarter basis, negative, right? A lot of these, like, smaller companies that have been financing and basically have been used to, it snowballs in two ways, right? Like, one is just, GDP, right? And just general growth itself, that is, getting suppressed, or is, forecasted to do so. And then on top of that, you've got, the cost of capital, at levels, the 2 year is at, four spot 245 right now. So, you've got that as well, right? So this cheaper debt financing, and that component of the game is no longer available. And so again, it's there, a lot of folks have kind of either, 1 year, 2 year, again, like typically is shorter, the shorter maturation. And those are the ones where, to Trent's point, I mean, he very eloquently, walked down the kind of, more intricate, detail. But I would say on a broader standpoint, it's really, it's GDP, and then it's cost of capital.
yeah. And to that point, Rob, this morning, um, the retail sales is a direct input into GDP along with industrial production. All that shit came out bad today. All that was bad today. So the
Yeah.
fourth quarter, the Atlanta Fed won't come up. They don't have a nowcast, so they will, a little later on. But I think that even the GDP in the fourth quarter, which looks to be a little up, might get impacted a little bit more from today's data. And then you're talking about the first quarter, solidly down. Maybe
Yeah,
those prints could be the trigger to finally trigger that market, because
exactly.
I'm astonished a little bit in here where these things are trading right now based on what seems to be, maybe I'm too in a bubble, but it seems like the data is getting worse and worse, and a recession seems to be, I think, in my opinion, inevitable. But they're hanging in there tight. So that's why I asked the question. I appreciate your input very much. Thank you.
Yeah, absolutely, absolutely. No, you hit the nail on the head, right? And Brian McGough, Hedgeye Retail is his Twitter handle. He's been talking about that on the call as well, in terms of just what his expectation is for, and for retail sales, and how a lot of that, those sales, especially for the holidays, year end, holiday sales were pulled forward, by either months or certainly weeks, right? And pulled forward out of kind of, certainly out of December. And so, by the time this data starts rolling in, it could be, certainly the credit card data, right? I think, they went into that yesterday, on the call.
Well, the
And
retail sales this morning were
well, yeah.
crap too.
And you're seeing it, right. And you're seeing it as well from the actual data. But I think, but like, as we move out in time, it's going to be even, it could get significantly worse.
Hey, Rob.
Yeah. Hey.
I still think it's just a matter of, I mean, it's like Ben Hunt says, everyone doesn't know, or it's when everyone knows that everyone knows that we're in a recession. I just don't think we're there yet. I think everyone knows that everyone knows we're probably going to be in a recession. I think that's pretty much common knowledge at this point, but we're not at the oh shit moment yet, where everybody goes, oh, we're here. And I think when we're here is when we start to see a lot of this stuff unravel rather quickly. I'm seeing that in the construction space, and the area I live, it's pretty,
Yeah.
people are pretty bummed out around here, and we know what's coming, but we're not there yet. We had a couple.
And to add to it,
and Danielle, sorry, Trent, like, Danielle DiMartini Booth, she was on the Macro Show this morning, and then had a really great session interview. I'd highly recommend everybody kind of go and watch her segment from this morning. But she mentioned that, right, Palmer, in terms of, as the data starts flowing in, they might go back. I believe, if I understood it correctly, like they might go back to January of this year and basically start the recession, at that point. Now, again, we don't have the data quite yet, but it'll be really interesting. And I don't know if she meant January of this year or if she meant like starting January 2023. I thought the way that I interpreted it was right. That's the way I thought I interpreted it, or that's what I thought she meant. Which again, to your point, Palmer, it's like, all right, like, recession, we've technically, again, if this data starts rolling in and it impacts it in that negative manner, then we, we all here on this call, know that we've basically been in a recession all year, but certainly Main Street and Wall Street, it isn't paying attention to that piece.
Yep.
Yeah. Trent, did you have something else to add? I apologize for cutting you off.
Yeah, no worries. I was going to just add to what Andrew was saying that, Andrew, as you pointed out, that in some parts you do see that difficult situation, right? So with housing, there's also a difficult situation if you go to certain tech hubs within the US. So, for example, San Francisco, Seattle, Austin, Boise, Idaho, all of these tech hubs are facing that challenge that not only there are layoffs, you can go to this site called layoffs.io and you'll find the details of all the tech companies that are doing layoffs. They're doing pretty significant chunks. So they're doing 5%, 10%, 13%, in some cases even 30%, 30. So, and these are companies of varying sizes. They are, of course, giving severance to people of 14 weeks and then some. Some of that curbing of spend is coming in already from those folks. In San Francisco and Boise, Idaho, for example, the real estate market is having much more faster month over month change. The official numbers that come out from Fred, St. Louis Fred, or in general from the BLS and other sources, they tend to give us a year-over-year number for be it housing or be it other aspects. But if you look at the month-over-month data from the likes of John Burns is a consulting that does ton of survey inputs as well. You'll find that the asking rate, people are willing to reduce their asking rate quickly, and also there's massive discounts being given by most of the developers to the tune of anywhere between 3 to 10%. And the way some of these developers are giving discounts are also in form of interest rate. So, for example, if you as an investor till last year were able to get a loan at say 7% or 6% as an investor, and today it's 10%, then they're willing to take up your 3% for the next 2 years. So they, for example, Lennar would do that. Bunch of others would do that. Those kind of discounts are being given forward. So I think segment by segment, the most interest sensitive segments are getting hit hard first, and then the others would follow slowly, steadily. Of course, there's parts of the economy and segments which will never get affected because 22% of the population is employed in government, right? That will never get affected. They will never face an issue with respect to what's coming in the economy because they never saw that huge set of rises or people jumping around jobs within government to get much higher pays like what they saw in tech or what people saw in terms of commissions and real estate. So I think segment by segment of the population will see this kind of drawback in or curbing of the demand.
Yeah, and X2 just shared a thread with me, so I put up in the nest there. So just around kind of forecasting rising unemployment from several central banks, in particular Fed and the BOE. So take a look at that. It looks like a good thread. I've not had a chance yet, but I trust my boy X2 explicitly. So thanks for sharing that, buddy. In terms of a segue here, and then we'll get over to Wasim. Hedgeye is hiring. Right. So as everybody else is firing, we've got several positions that we need to fill. And so if anybody knows anybody, I'd say, go to the careers page on the hedgeye.com website. Please, if even if the profile for that role doesn't necessarily, fit perfectly into what you've done or what you've accomplished or kind of your background, we really want to, we want to see, we still want to see, the resumes, right? We want to be able to have folks that are, certainly, either similar that are within kind of Hedgeye Nation, right? It's like it's a brilliant way of kind of getting people on board and that kind of thing. So if you've got anybody that whether it be, a child who's graduating, right, or a friend or what have you, by all means, send them to that careers page. But then also email it to dholland@hedgeye.com. So that's Dan. So D Holland, HOLLAND at hedgeye.com. He's the one who will sort through those. So awesome. Wasim, welcome, my friend.
What's going on, man? How are you?
I'm doing well. How are you?
Good. I have a bit more of I have a question for Trent, a bit more of his process question in terms with in how he deals with options. So Trent, when you're putting on puts or calls, what's your how do you think about time frames in terms of going 1 week out, maybe 3 days? Do you do like short-term options? Are you more mid, long, and how do you think about those setups? For me as of right now, like I'm thinking when there's a big change in something, when something's going from bearish to bullish, I'm typically going longer, and then kind of just if something is just in a current trend, and I'm just trading the range, I'm typically doing maybe a week or 3 weeks out. But I just want to kind of understand how you kind of think about that.
Good point. So max, my options book will not consume more than 20% of my total portfolio. So that's to begin with the top level control line. Super short term, like you're talking about weekly, etc. I don't exceed more than 1 to 2%. So that should give you a sense of what individual position would look like. They tend to be in like multiples of tens of basis points, and then. From that's for super short term, like you said about weekly, right? And in weekly or daily, I would usually just look at the index options rather than individual securities, unless it's an event driven individual securities item. For example, some event is popping up like earnings, or they could be the Stewart thing or whatever. Those kind of situations are popping up, then I would jump in with starting with 50 basis points or even lesser. And then from a medium term perspective, majority of my options in that 20% would be something around 2 to 3 months out. And it tends to try to protect me from wall crush as well as theta decay in form of verticals. Sometimes I'll do risk reversals. For example, 2 days ago when I did the Microsoft one, I looked at it from a 3 months out perspective as well as from the earnings perspective, because earnings was giving significant amount of vol. So I structured two trades. One was for Jan 27th, one was for March. Both of them had put verticals long, and then the call vertical short for out of the money. I don't try to go too much out of the money for the immediate position. I'm usually at the money for one leg and at about 30 delta for the short leg. So that way I'm slightly protected from the theta decay as well as the wall crush. But keep in mind that reduces your delta exposure. So those kind of things also come in place. So those three things should give you a sense of how I position those options part. The total option exposure is not more than 20%.
That's cool. And okay, so you're not, and are you ever buying out like a year or anything like that, or
Very few, very few.
very
So,
few?
for
Okay.
example, let's say if there's tail duration calls from not even tail, so trend duration calls from say on the retail side, if Brian has something, right, or if I have some deep analysis done on a stock. So, for example, Sprout is one company. It's a social media company. It's nothing but an API that they get from Twitter, and given what Twitter is going through, they're going to raise rates on them. So that is going to hit the earnings really bad. The ticker symbol is SPT, Sam, Peter, Tom. And then they're going to have significant issues. So in the recent pop-up, the stock went from like 53 to 69. That was a great setup for buying. The furthest out was available expiration was October, so I bought an October set of puts, which I'll convert into put verticals and then just let it ride. So very few cases I would go for leaps. What you're talking about are leaps, right? Typically they tend to be a year out or more. In this case, the farthest out was October, so I just bought at the money puts for Sprout.
Okay, that's cool. That's very helpful. Thank you, Trent.
Rob, any more inputs on the commodities front other than the energy commodities? You mentioned about coffee and a few others, right? Um, do we eventually start seeing eyewall discounts on some of the other ones as well? Rob, if you're saying something, I can't hear
Sorry,
you.
sorry. What's the question? Sorry, just like
No, it
generally
was
in
related
commodities.
to generally in commodities.
Yeah. So I can go through what I can definitely I can get into that, and then also have a special guest here in the studio with me. We've got Ryan Ritchie who just came in.
Oh, cool.
He he pinged me and said he's got a few things in his notebook that he'd really love to share. So he might have a couple commentary on the commodities as well, Trent. So I'm going to pass the mic over to him and give him a warm welcome to the one, the only Ryan Ritchie. He did not put in a shift like I did last night, so his brain's definitely a lot clearer.
I will be putting in one tonight.
That's right. That's right. Holiday party, baby.
Yeah. Well, yeah, I actually don't have too much on commodities, actually, Trent, unfortunately.
That's
Not
okay.
gonna
That's
lie to you.
okay. What are you got?
But
Because you go
I
throughout the globe, that's why. So, what are you
yeah,
got throughout the globe?
yeah, throughout the globe. I mean, I don't know if anybody saw Taiwan went down 17% in the last 3 days. Which is unbelievable move there. I don't know how much as well you guys talked about like covering shorts today as well. So like everything on my page is screaming a lot of oversold. Doesn't mean you cover all, right? But it's also about taking down some of that exposure or net exposure that you may have put on as well. Because I have Apple's very close to the low end of the range, Nasdaq, the S&P, which is kind of like Apple. DAX as well, also at the low end of the range as well. So again, covering is also really big in these moments as well. And then you can also add that. I don't know if you guys talked about defensive stocks yet. ITA was sitting right there at the low end of the range as well right now. So a couple of things there. And then in terms of international data, really, I mean, so bad, really bad data came out that from what I saw. So Indonesian exports, it came down sequentially, but interesting on oil here trend. Their crude oil exports were down 29% year over year. Nat gas exports were down 17%. So again, it's you're talking about like demand destruction and just limited demand internationally. We're just seeing it everywhere. And then interesting on Indonesian imports, they actually were down 1.9%. Last month they were up 17%. Consensus had them at being up 7%. So talk about a miss.
Yeah.
Like holy cow. Just unbelievable stuff going on there. Also internationally, we're seeing a lot of stuff. Inflation everywhere is coming down. Not everywhere, I should say everywhere. A lot of places it's coming down. It's coming down sequentially. But again, that's where Quad 4 lives, is in that environment. Let's see, where else can I span the globe? I heard you guys talk about higher for longer. The ECB was, talk about a clear message. And yeah, that's what's popping off my page today. It is really just a lot of the same stuff. Yeah.
Yeah, also the German two stance after the ECB messaging just hinted recession big time, right? Like they nosedived.
Yeah, absolutely nosedive. I think it was like down 10 basis points. I know McGrady put out on his Twitter the Netherlands one. That thing got to its all time low. It's just negative 6 basis points wide. And
Generon, that slide is in the nest if you want to throw it on for those that are watching. But yeah, for anybody who's just on Twitter, just check the nest. There's a couple of those tweets are in there.
But also with all this negative data too, like this is also not the time to just open up new shorts and get even shorter, right?
Yeah.
So that's kind of like the thing with us at Hedgeye, right? Where it's like balancing all this data that we have that is forward looking with the intermediate, like in the today's trade as well. So,
Yeah.
but yeah, I saw that trend on the German. That was unbelievable.
Yeah, I mean the German 10 years, the 10 years up 7.5, a little over 7.5% right now, right? Today alone, like and the Japanese 10 years up 2%. The British 10 years down about 2%, but it's what's happening in Europe. And again, I tweeted this out earlier because I think it's incredibly important. We've got to be able to see. We got to be able to. Just like pay attention to what's happening in Europe because it's really just beginning. And but does anybody have any follow-up questions either for myself or Richie? I saw Newton came on.
Yeah, thank you.
Absolutely.
Hey, Ryan, I was wondering, I was going to pass this just to the group and Trend earlier, but since you're our ETF guru amongst many skill sets, I've just been looking at ways to play profitless technology stocks in the ETF form on the short side. I've used shorting ARK, ARKK, or buying SARK, SARK, the inverse of that, as one technique, as well as doing individual stocks. But just kind of looking for a way where I go in on individual ones, and they don't necessarily, if I time it improperly, we hit a little bear market rally, they go up, I'm happy to sell them, book the capital loss, and wait 30 days to revisit them, but would like to have a kind of a way to more broadly play that trade-wise. So if there's anybody that has a thought on profitless tech ETFs, that would be great.
Yeah, I have a lot of ETFs for you in terms of profitless tech. So a lot of these are down a lot today. So again, don't short these at like this.
This is not investment advice.
Yeah, not investment advice at all. But I've been playing around with some like metaverse stuff. So Fidelity has one of those. FMET is an interesting one. There's a lot of stuff in profitless in terms of online retail. So we have IBUY. That one has a lot of stuff in it. There's so much stuff that's just profitless junk. I mean, there's so many you can Google Bitcoin ETFs as well, and almost all of them have profitless in them. A lot of them have actually Silvergate exposure. So what I've been trying to actually do, I'll just type into Google Silvergate ETFs or ETFs with Silvergate exposure, and it gives you a list, and every one of those looks the same. But yeah, I mean, the list goes on, but
yeah, that's good. I mean,
Thank you. Appreciate it.
Yeah, and Newton, on ETF DB, there's a mechanism by which you can reverse search exactly as Ryan pointed out, that you can go there and say, hey, I want to search this kind of stock. So for example, let's say a good profitless tech stock is Asana, ASAN, and like Yogasana, right? So Asana, and you could just put in which ETFs own Asana, go in there and then check the specific category of small to mid caps, because some of these were large caps. Think about it. Asana was having a $25+ billion market cap, and this company wasn't even clocking 100 million in a quarter. So talk about excessive valuation, right? And then now it has come down from 125 to $14. So is this the best time to go short on them? Maybe, maybe not. Asana is a different beast altogether. It has a good team backing it, but there are other easier plays. And for ETF research, I personally use ETFDB a lot. You can even use the Fidelity screening tool that Fidelity.com has. It's free. ETFDB charges you, I think it's like $200-300 a year, but Fidelity.com provides you a lot of screening mechanism for ETFs for free. And you can actually, over there, you can even say that the mean price to equity is say 50 plus or something of that sort for the overall portfolio, and that would give you a sense of which are profitless tech. And it doesn't have to be just profitless tech, right? Any company which gives you profitless growth sort of situation could be well, meaning Coinbase, for example, not a tech stock per se, it's an exchange, and it's profitless. So it could be whichever ETF holds Coinbase, right? Or Metaverse, as Ryan pointed out. There could be different themes. So dig into the thematic ETFs. Some of the themes would definitely take a beating.
Yeah,
Thank you.
hey, Trent, was it Stock Rover or was it the other one? IZV something. I think it might be Stock Rover.
For which one?
Just for like where you can put in, short interest exposure. You can put in, EBITDAX, but you can basically narrow down list that you use one, and I do too. I'm just drawing a blank. I can't think about it right now.
Oh, for short interest, I use Zentio, but that one doesn't need that tool. There's another one called Finviz,
Finviz.
FINVIZ.
That
Yeah,
was the one I was thinking of.
yeah,
Yeah. Finviz. Yeah,
yeah.
that's a
Finviz gives good screener in
great screen.
general.
Yeah.
Yeah, but
Yeah.
keep in mind just screening the stocks and then connecting them to ETF because I think Newton asked for ETF, right?
Yes.
Yeah,
100%, Trent. 100%.
yeah.
But Finviz. But in terms of Newton, in terms of like, if you're looking for, profitless tech, right? You can go screen there, and then you can go Google, where, what ETF are they in, and then you can kind of start connecting the dots.
I will noodle around and report back to the group.
Brilliant,
Thank
man.
you.
Brilliant. All right, so we're coming up on a little past the hour. Anybody out there in the crowd, if you got any commentary or questions, by all means, step back. Come up and chat. Otherwise, we may we've covered a lot today, and it's been very valuable. We got about an hour or 45 minutes or 55 minutes, excuse me, left in the trading day. The one thing we haven't talked about, well, I guess we talked about volatility a little bit, but specifically, we talked about oil vol. But I think if you look at like VIX itself or just volatility in general on equity exposure, so VIXN, RVX, etc. They're all still very squarely inside of their chop buckets, right? So, when Ryan here was referring to kind of today's a bit more of a moment to be covering some, right, and using that quote unquote hitting the button on the buy side of things to perhaps decrease your net exposure, then that's very, I guess, prudent to do, or certainly would be following the process here in the chop bucket. And especially with VIX at 2271, not quite at the top end of the range, but still, again, just really the main point I wanted to reiterate is just that we are remaining squarely inside of the chop bucket right now. Jimmy, you popped up. Welcome, my
Good
friend.
afternoon, Robert. I hope you guys
Good
have a
afternoon.
great holiday party. It's been quite the year
Thank
for
you
you
very
guys.
much. Thank you.
Yeah,
Yes,
welcome to the
fun.
squad.
I don't know if you were on earlier, but I got a little ugly sweater, a great little knitted sweater with Santa Claus skiing. I believe Freebird is wearing an ugly sweater as well, so it should be a lot of fun.
Absolutely. I've been just covering some shorts all day and following Coach, kind of getting the idea if we get this pin action tomorrow during quadruple witching to load up a little bit more. My only incremental commentary is that looking at crypto, still above the midpoint of the range, and we're now right past that 1 month period where crypto puked, I think, on November 9th. So I'm on the Bitcoin trend tracker. Not sure if you guys all follow that, but when you start looking at how the 30-day realized volatility is now rolling over because we're past that period, we have a massive implied volatility discount. And crypto has its own way of doing things, but for all the people who are hoping that the bottom is in, now that the market's rolling over a little bit, I think it's still quite juicy. So, might press that a little bit today. I'm going to stay nimble, but the trend is very clear. And when it goes bidless, it's going to go bidless. So that's kind of how I'm setting up for things.
Yeah, I agree with what Jimmy just said. I maxed out. I use Biddy.
Yeah, nice call out. Yeah, we haven't talked about Bitcoin yet, so well done. And I completely agree. So
By the way, I am seeing on that on the YouTube live channel, there's at the bottom there's a Bitcoin trend tracker mentioned. So for folks who have not looked at it, definitely look at it.
Nice,
Yeah, that was a
nice
great.
plug, Trend. Yeah. I don't know who's
Love it.
Seltzer's
I
on
think
Twitch. Yeah, that's a good
I
plug,
think
right? Yeah,
Genron did that. Genron did that.
that's right. That's right.
So here I want to add something which is interesting and important, which you will all see tomorrow at the closing. That is of index rebalancing. So December 16 also would bring a similar situation like what we had a couple of years ago when Tesla was included and something else was excluded. We'll have a couple of replacements here. Keep an eye out for that. It is going to be interesting. A few names will be thrown out of the S&P 500 to S&P 400. Some will be promoted from S&P 400 to 500, and similarly between the mid cap and the small cap, which is 400 to 600. But the biggest impact, which already quantitative players tend to put into play, are those of the lower market caps and non-earning companies in S&P 500 to be thrown out, and the higher market caps in S&P 400 to be brought in. So keep an eye out for that. You'll see a bunch of moments around that. But if you're trying to play that for immediately the next few days, right now it's too late because typically the quant players will put in probabilistic basket trades for these kind of things at least 6 to 8 weeks in advance, and then you'll suddenly start seeing large volumes on those few names at the market on close tomorrow. So keep an eye out. I don't expect a huge change in terms of number of stocks or tickers that will be included, but at least 2 to 3 replacements will be there. So you heard it here first on Rob's WNR.
That's right, baby. No, nice call out. Yeah. That's I'd missed that. So good. Well done, Trent. Appreciate it. The volume's pretty. I was just kind of looking at the volume on SP. It's pretty light right now, which is interesting. But anyway, cool. All right. Well, we'll. Anybody out there? Anybody's got any questions? Anybody that's on the panel right now? Any additional comments or questions?
Just one thing, Trend. Did you say that website was ETFDB, like DarrenBobby.com?
Yep.
That's correct. Yep,
Okay.
That's correct, Wasim.
That's all.
Yeah, it's a great one. It's a great site. You can use it to see how many. So if you put in, I don't know, Apple or whatever. Like Newmont's a good example, right? You can kind of see, okay, how many ETFs, Newmont is actually held in, and so it's really quite a very useful website / database to kind of get a better understanding as to various exposures and underlying inside of the ETFs themselves. And for Newmont in particular is quite impactful because if you're getting just general selling out there, right, Newmont might get impacted more so versus say other gold miners because of its size and the, it's quite a large ratio in terms of the ETFs Newmont's in versus say something like a Barrick Gold or something like that. So all things to be paying attention to, right, Trent? Connecting the dots.
Yep.
Connecting the dots. Awesome. Well, this has been a great session. So really appreciate everybody joining in. Next week, we'll be back to our regular scheduled program of Wednesday at 2 p.m. Beginner's Guide is happening tomorrow morning at 11:30. I will be prepping for that this afternoon and putting up the post in the arena. So if you've got any kind of questions that you might want me to cover, by all means, put them in there, and I'll do my best to answer them. And we appreciate all of you. You guys are unbelievable members of just the community, and you're all great people. So just wanted to thank you for participating in not only the Week Notebook Review, but just being you. It's awesome. We love all our Hedgeye community, Hedgeye Nation, and it's an absolute honor and privilege to be here in this seat now. And hopefully I'm doing right by all of you. So I appreciate it. And we will see you. Well, I'll see some of you tomorrow. A bit more of a one-way communication there, but I'll certainly see you next week on the two-way comms here on Spaces.